Hey, it's Tom here and welcome back to the channel. So just last night I was scrolling through YouTube on my phone and came across a clip of Warren Buffett at his annual meeting in 1997. And basically Warren Buffett went on to talk about many of the very high valuations that were present in the stock market at that time. This was about 2 or 3 years before the tech bubble burst in 2000, and leading into that period, the valuations on really good businesses were getting quite high, and the valuations on low quality businesses also were getting quite high. It was a really unusual time in the stock market, and I think there are a huge amount of parallels from what was going on in the late 90s to what is going on today, and I want to sit down and basically react to this video and give you some of my thoughts on a few things that Warren Buffett said. So without further ado, let's get straight into it. A couple of initial shout outs first. Buffett Answers is the YouTube channel that I'm watching this clip on. I will leave that link down in the description below. And also a quick shout out to MD, who I noticed in the comment section last night. I know he's a long time subscriber to the channel. So if you're watching, shout out. But for now, let's get straight into the video.
Buffett, my name is Pete Banner, and I'm from Boulder, Colorado, and I'm a shareholder. Recently, Mr. Greenspan made his comments about exuberance, and it wasn't long thereafter that you came out in the annual report and made your comments that you felt the market was fully valued or something of that nature. Did you have or have you had any communication with Mr. Greenspan regarding the valuation of the stock market?
No, the answer to that is no. I have the last time I
For those wondering, Alan Greenspan at the time was the chair of the Federal Reserve, I believe.
well, I can't remember precisely when the last time I saw Alan Greenspan was, but it was a long time ago. We had one conversation today of the Solomon crisis, and he was formerly on the board of Cap Cities before he took his job with the Fed, and Cap Cities ABC, so I knew him then. But you know, it's very hard to understand what Alan says sometimes, so there's not much sense talking to him. I mean, he's very careful about what he says. But I'm glad you brought up the subject of the annual report, because what I was doing in the annual report is I had talked about Coke and Gillette as being the inevitables and what wonderful businesses they were. And I thought it appropriate, particularly the report goes to a lot of people, that they would not take that as an unqualified buy recommendation about the companies, because they're absolutely wonderful companies run by outstanding managers. But you can pay too much, at least in the short run, for businesses like that. So I thought it was only
This is a concept that Warren Buffett actually talked about quite a bit in the 90s, was this concept of the inevitables, basically businesses that were almost guaranteed in his mind to do quite well. In that basket of businesses at the time, he talks about Gillette and Coca-Cola. Gillette is no longer a holding for Warren Buffett for reasons that I don't want to get into in this video, but Coca-Cola, as many of you will know, is still a position that Warren Buffett holds on to. But you may have heard him mention it very quickly there, and he'll mention it quite a bit more throughout this video, is that you can pay too much for those businesses, particularly in the short run, is sort of the way he worded it. So no business, regardless of how high quality it is worth an infinite price. And you know, if you buy into a high quality business and you do pay a little bit too much, you know, just the high qualityness of that business and the continued growth of that company can get you out of trouble over a long period of time, but it can really put a damper on your returns if you overpay for that company in the first place.
Appropriate to point out that no matter how wonderful a business it is, that there always is a risk that you will pay a price where it will take a few years for the business to catch, or for the business to catch up with the stock, that the stock can get ahead of the business. And I don't know where that point is with those companies or any other companies, but I did say that I thought that the risks were fairly high, that situation existed with most securities in the market, including companies such as Inevitable. But it was designed to be sure that people did not take the remarks that I made about those companies and just take that as an unqualified buy recommendation regardless of price. We have no intention of selling those two stocks. We wouldn't sell them if they were selling at prices considerably higher than they are now. But I didn't want, particularly relatively unsophisticated people to see those names there and then think this guy is touting these as a wonderful buy. Generally speaking, I think if you're sure enough about a business being wonderful, it's more important to be certain about the business being a wonderful business than it is to be certain that the price is not 10% too high or 5% too high or something of the sort. And that's a philosophy that I came slowly to. I originally was incredibly price conscious. We used to have prayer meetings before we would raise our bid an 8, around the office, but that was a mistake.
I think that's a really good point, and frankly, this is an area where I've grown over the last year or so as well. I used to be super strict on, trying to get the big 50% margin of safety and so on, which I still largely try to be. I'm really still trying to buy $1 worth of business value for 50 cents in the stock market. But you have to understand that intrinsic value is not a number that you can pin down to 3 decimal places or anything. It's a range. So if a stock price gets within at least a reasonably tight range of that target price, I'll be more open to buying that particular stock. There have been a couple of companies where I have actually one where I've completely missed out altogether. I just didn't pull the trigger because it, didn't get right to the exact cent of where I was wanting to buy it at the 50% margin of safety. And there's been other examples of businesses where I have bought an initial position, but I haven't been able to buy in the full position, the entire amount that I want, again, just because I was slightly price conscious, and maybe it's just a sign of the times. But in both of those cases, that has cost me money. I would have been a little bit wealthier today had I just pulled the trigger at slightly higher prices. But notice that Warren Buffett is talking about quite tight ranges. He said, don't get caught up on 5 or 10%. He's not saying don't get caught up on 50 or 100 or 200%. There is a point where paying too much definitely hurts your returns quite significantly.
And in some cases a huge mistake. I mean, we've missed things because of that. And so what I said in the report was not a market prediction in any sense. We never try to predict the stock market. We do try to price securities. We try to price businesses is what we try to do. And we find it hard to find wonderful, good, average, substandard businesses that look to us like they're cheap now. But you don't always get a chance to buy things cheap. Charlie?
Well, I certainly agree with that. The one thing we can confidently guarantee is that real inflation-adjusted returns from investing in a standard collection of stocks will be lower in the long-term future than they've been in the last 15 years or so.
That is uncanny how familiar that statement is to something Charlie Munger actually only said a few months ago. He said almost that exact same thing about the stock market today. I'll maybe try and stitch that clip in here just after I'm about to stop talking now.
Why?
The answer is yes.
And could you give us a hint as to why that might come to pass?
Yes, because so many people are in it, and the frenzy is so great, and the systems of management, the reward systems, are so foolish that I don't think it's going to work at all. I think the returns will go down. Yes, in real terms, the returns will be lower. Unprecedented period, and there will be some regression toward the mean in average returns from investing in the stock market.
American business has done extraordinarily well in the last decade plus, and that's a huge plus for securities because they just represent pieces of those businesses. Interest rates over the last 15 years have fallen. That's a big plus for stocks. Anytime interest rates go down, the value of every financial asset goes up in rational calculation. Both of those factors have combined in recent years to produce conditions that enhance the true value of American business.
This again is incredibly similar to what we're seeing today in 2021. We've had 10 years of, with a bump in the road being the exception in 2020, but largely we've had 10 years of spectacular business growth, and we've also had 10 years or so of interest rates just being pinned pretty much at zero, and they've even they tried to put them up a little bit a couple of years ago, and then they've basically come straight back down to zero. So there are a lot of people talking about the stock market being priced abnormally high. I tend to agree with that, but one of the things that you have to keep in mind is that if there was ever a time for stocks to be priced really high, rationally, it's probably now. It's probably at a time where business growth has been really good and interest rates are really low. It would be surprising to me if the stock market wasn't priced really highly in a situation like this, but like Warren Buffett, I think, is about to say, there is a point at which, again, it just gets too far ahead of the underlying businesses in terms of what the stock price is doing.
But those are pretty widely recognized now, and after a while, Ben Graham always used to say you can get in more trouble in investment with a good premise than with a bad premise, because the bad premise will shout out to you immediately as being fallacious, whereas with a good premise it'll work for a while. Businesses are worth more money if interest rates fall and stocks rise, but that eventually the market action of the securities themselves creates its own rationale for a large crop of buyers, and people forget about the reasons and the mathematical limitations that were implied in what got them excited in the first place. And after a while, rising prices themselves alone will keep people excited and cause more people to enter the game, and therefore the good premise after a while is forgotten, except for the fact that it produced these rising prices, and the prices themselves take over. He wrote about that in the connection with the 1920s, when Edgar Lawrence Smith in 1924 wrote a fine book on why stocks were better than bonds, and that was sort of the Bible of the bull market of the 20s, and it made sense if you paid attention to a couple of the caveats which were in Edgar Lawrence Smith's little book, which were related to price. But people tend to forget about the importance of the price they pay.
Fantastic point. So what Warren Buffett is saying here is, the two drivers for stock price appreciation, like we just talked about earlier, with business growth going up and interest rates going down, are very real, factors that should drive the intrinsic value of businesses up. But again, you've got to be conscious of price, and at a certain point people see these stock prices going up at first rationally, but then they sort of get drawn into just the fact that prices are going up, which causes more buying because they sort of want to get in on this and they see their neighbor making money and so on. And eventually it just kind of spirals out of control, and like Warren Buffett's saying here, things get kind of detached from reality in terms of, rational prices to pay. That is a massively important component of doing well in investment. Imagine if you went and bought a rental property down the street that brought in $10,000 a year in rent. If you paid $1 billion for that house, you're probably not going to get a very high income or a very high return on that $1 billion of capital that you put into that real estate. So even if that's a super high quality house that's going to get good reliable tenants for a long period of time, and the rent will go up a few % a year for the rest of history, if you pay $1 billion for that house, you're going to struggle to get a good return. So price is exceptionally important.
As the experience of a bull market just sort of dulls the senses generally.
And that is the end of the video. So I love going back and watching some of these old Warren Buffett clips. I think that they are incredibly powerful in terms of trying to relate to some of the things that are going on today. This is a fantastic example where there's a lot of parallels between what was going on in 1997 when this video was filmed and what's going on today in 2021. So I'd love to hear your thoughts on what Warren Buffett was saying here. Do you think this has parallels with what we're seeing today, or am I just dreaming this stuff up? I'd love to hear your thoughts on that. And also if there are any other Warren Buffett or any other investor clips that you'd like to see me sort of react to and give you some commentary on, definitely drop those down in the comments section below. I actually really like making these types of videos. These are fairly simple to put together, and it also allows me to share some wisdom from people that are a whole lot smarter than me, and I can maybe add a little bit on top here and there to hopefully help you out along the way as well. But that's it from me today. Do hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.